Hi folks, let us take a moment to introduce the stochastic indicator. Once again, that's the stochastic indicator. It's this area right here. The stochastic oscillator is a smooth, normalized momentum indicator with set lower and upper boundaries of 0 and 100. So it can't go any higher than 100, can't go any lower than 0. It consists of two lines, the %K, which measures the relative position of the current close within a price range defined by you, the user, and %D, a 3-day or 3-bar average of the %K line that functions as a signal line. So that would be this red line, the faster line here. When %K, the red line, crosses above or below %D, a market turn is implied. The essence of this indicator is to try to tell you where market turns are occurring. It's based on the supposed tendency of price to close in the direction of the trend, that is, closing toward the upper end of the price bar in bull moves and toward the lower end of the price bar in bear moves. So what that's telling you is this: as price is closing in the upper end of its range, so let's go back here, right? It closed here, in the upper end here, in the upper end here, in the upper end here. So what will happen is the stochastic will move higher, right? As that changes and price begins to close in the lower end of its range, you will have that roll over and go lower. It can be noisy, but the way that we use it is this. We look for opportunities when within a given trend, however it is we define trend, price becomes oversold within the context. In this example, this is a rising trend. We would look for an opportunity where price became oversold, right? And then we would look for either a cross or some other trigger to get us involved in a trade in the direction of the predominant trend, right? So that's what this indicator is. It is, once again, the stochastic oscillator, and we use it to frame the structure that we're working with and help us understand where we are within the confines of a particular move.